Good afternoon, everybody. Welcome to TraderMerlin Show for your Monday edition. I will probably sound hoarse and raspy. I am still struggling with this flu. I took a second COVID test, and we're definitely not having COVID. So I guess that's a good thing. The bizarre part is it's almost the exact same symptoms, and it's just been a struggle. But hopefully I'll clear up by the rest of this week, so I'll probably do shorter shows just because that's pretty much all my throat can handle is do those shorter shows. For those of you who might be new, this show is driven by you, the viewers. So if you have questions, comments, feedback, things you want me to discuss, feel free to send those on in. Although I do see that most people here are probably the regulars of the group. If you are new, hit that subscribe button so you can see when we go live with our content, which is usually 2 p.m. Pacific time, Monday through Friday. All right. So today's show is derived from actually one of the viewers' questions. It was posted on the YouTube channel, and you can put questions on any of the YouTube videos. I will see those as soon as you post those, and I usually take that and put that into content for the show. Today I'm going to really wrap it around a viewer question, which is this one here from Skilled Stocksman. He says, my question is about futures contracts charts, the unadjusted versus the adjusted. My first instructor was for futures was Craig Weil. He insisted on unadjusted futures charts. Second instructor was for futures was Bob Dunn. He preferred adjusted charts. What's your take on the pros and cons of each one? Because when I was hearing this from them, I was very new and did not remember what the benefits and bad things of each were. So for me, I guess it really depends on what your style of trading is. If you are a short-term trader, it doesn't make a difference. Who cares? If you're a longer-term trader, I actually really do think it makes a big difference because of the way levels are formed. So for those who may not know what we're talking about when we say adjusted versus unadjusted, and it's not just futures charts, it's other charts as well. Certain stocks will pay out dividends, and certain futures products will pay out dividends as well. So if there's ever a distribution, the chart in some platforms will automatically adjust for that to take out that dividend, so there's no gaps because they don't want to see the gap. Unfortunately, what it does is over the course of time, it will distort what that price chart ultimately looks like. So, for example, I guess maybe I should show the graphic here. There's my graphic for today, adjusted versus the unadjusted. Yes, so you're doing the unadjusted, Pepe. So in TradeStation, I don't even use the futures charts on TradeStation really anymore, but yes, that's the 107XN is how you would make it the unadjusted. So it's actually easier in TradingView, but let me just ask you guys, there's major milestones that happen in the markets, and for me, my brain thinks of those numbers. For example, I remember going back into the 2009 lows. Can anybody tell me off the top of the head what the low of the S&P 500 was in March of 2009? Now, for some of you who just started a couple years ago, you're probably thinking, who cares? No big deal. It doesn't matter. Well, in my mind, it does. It's such an ominous number, and it's this line in the sand that to me is very, very important. That if it gets down there, I expect that level to act as an area of demand. Or up until we broke it recently on the S&P, the all-time high was 1576. Well, that was the high that we saw back in 2007. And for me, that was also very important. Right, so Big Eb, you're just slightly off there. You said 700. Daryl's right, it's 666, right? 666 was the number, and it was so funny because we hit that, and I was like, oh, crap. I mean, could it be more ominous having the devil, the symbol of the devil, right? Iron Maiden fans are going, yeah, let's kill it. It actually was, I think it was 665.9, but we just said, we'll call it 666, right? So here's the picture of it. Let's go back, and I'm going to zoom in here. This is the weekly time frame. Let's just go back here to these lows in 2009, and I'm going to put my cursor right there on the lowest point that you guys can see, right? That's March of 2009. Right above it, just follow that red line, that dotted line from my cursor, straight up that screen, and you'll see it says the low there was 665.75, so 666, right? That's a number that will be stuck in my head until I'm buried in a casket. I remember that vividly because I was heavily trading at that moment. But this is an unadjusted chart. I mean, it's not, over the course of time, when S&P pays out a dividend, it's not adjusting the chart for those dividends. It's leaving it alone as it is, leaving those gaps. Now, down here at the bottom, you see it says B adjust. If you click on this, and then there's contract rollover changes, there's dividends being paid out, there's other things that could cause this chart to look a little bit wonky. But I'm going to click on this B adjust here, and now it's going to make it an adjusted chart, meaning when it has a gap for dividends, it's going to take it, it's going to remove that gap and adjust the chart accordingly so we don't have gaps. But watch what happens to this. I'm going to go back to that exact same low. Here's that low point, right? I'm going to click right on it, and now we are at March, the week of March 2nd, 2009. Now look up at the top. It says that the low was 458. What? It was 666, folks. It was not 458. And the reason I have a problem with this is if you're looking out longer term and you're using any of these levels over here, right? So here's our long-term chart. If you're using any of these levels that go back even just a year or two, it's going to change that number that you view as a supply level or a demand level. It's going to change it. It's not actually going to be a supply or demand zone because it's adjusted. What you need to do, in my opinion, for anything long-term is keep it on the unadjusted chart, right? Even this low back here, let's see how much it throws it off just in the past 2 years. This low that we see back here on March 23rd of 2020 was 2,174. But if I adjust it, it says that the low is now 2,150. Well, that's 24 points lower. I apologize for the coughing, folks. It's going to happen today. So I don't like using adjusted charts. Now, if you're a day trader, it doesn't make a world of difference. Who cares, right? If you're just trading short term, 5 minutes, you're trading on a daily chart, maybe the last couple of days, big deal, it changed by a couple of cents, maybe. Who cares? But if you're longer term, I think you have to be using unadjusted charts, in my opinion. And that's just, it's one of those age-old debates that rages on. It's like technical analysis versus fundamental analysis. Red versus black on the roulette board. There are always going to be these discussions about what you prefer. The reason I like the unadjusted better is because that's what price actually traded at. It traded at 665.75. That's what the low was. So if you look at somebody that's looking at the charts now that's using the adjusted chart, it didn't trade at 470, but you're now making that a demand zone. It never traded there. So how could that be a demand zone and cause price to bounce back up? My job is to not forecast, that's the wrong idea, but to anticipate market moves, right? I'm anticipating when things are going to be going up, down, or sideways. And granted, I'm wrong quite a bit. I'm right quite a bit. And the key there is when I'm right, I want to hopefully have winners that are bigger than my losses. And when I'm wrong, I want to keep those losses small. If I'm using data points, supply and demand zones that are not based off of fact, they're not based off of actual prices. There's no buyers at 400 on the S&P back then in 2009. How can that actually be a real demand zone? So that's my main reason. Pepe says, agree with Merlin, and because the wilderness of the markets, I only use those unadjusted. Correct. And you can look at other price charts. For example, let's look at something like Apple, right? So Apple pays dividends, right? And let's just do it on a weekly time frame. And look at this low back here, right? This isn't that far off. This was the COVID low of 2020. And you can see right where my cursor is. Just look up at the top of the screen. You see there it says L 53.15, right? $53.15 was that adjusted dead low from the initial COVID pandemic fears. Well, down here you see it says ADJ. So I'll click on that real quick. My memory's covered in Theraflu right now, but 53.15 is what it was unadjusted. When I click on adjusted, that number is now 52.20. That may not seem like a lot to you, but that's 90 cents. That's a 90-cent difference where that demand zone could be skewed. And it skews that number. And that's not that long ago, right? I think it's very logical to look at this demand zone. If we start to break these current levels and start to really trend down aggressively, sure, you could argue that $52 area could be in play. And if I'm looking at the adjusted data, well, my low point is going to be about 90 cents lower. So I might even miss that demand zone because the people who are trading off of the unadjusted, which is where I keep all my charts, the unadjusted will have gotten in earlier. They'll have gotten in at the 53.15 mark, and you're still waiting for it to get down to 52.20. You missed the boat if it turns on those levels. Quick roll. Who uses adjusted charts for the trading? Here's the funny part about that. That's a great question, Gallo. I think most people just don't know. They log into a platform, they log into E-Trade, Ameritrade, Schwab, whatever, and you just use the chart. They just simply don't know. So let me, I'll start the poll. Why not? Let's see. Take me just a second here. Copy that over. It should be, do you use adjusted charts for trading yesterday? How about that? I'll ask the community. So there you go. The poll's sent out. Thank you, Gallo, for that one. And again, it's a matter of personal preference. I like in the very beginning of your question out there, Scott Stocksman, you say, you know, Craig Weil insisted on unadjusted, yet Bob Dunn was saying he preferred the adjusted charts. And I think ultimately it's just a matter of personal preference. To me, I got to make sure that the prices I'm trading were actually traded at. I know that there's traders like me who have memory of levels, and those numbers burn into your brain. And I want to know when it gets back to that level, that zone that's in my brain is going to be there. Well, if I'm using the adjusted chart, it could be completely off. I mean, it could be multiple points away from those current levels. Excuse me. Hey, Merlin, how do you place Plave on order with 2 targets? So you're talking about doing a bracket order, Eric. In TradeStation, if you want to place a bracket order, yes, you would use an let's say with two targets. You could use either one of those, but inside of the OCO or OSO, depending on whether you've opened the trade or not, you use OSO or OCO. You could specify the multiple targets within the setup for the OCO or OSO. So you can set up multiple targets in there, multiple stop losses if you want, but it's not dependent on OSO or OCO. Those are dependent on, do you have a trade open right now, or are you going to open a trade? Yeah, so one OSO is order sends order, or one sends other. OCO is order cancels other. Okay. I did Pepe, but off the top, I'm still under the weather, so I've not been really paying much attention to my emails or anything like that. I've really been just sitting on the couch watching mindless TV, which is just absolutely driving me nuts. I hate it, I have to say. Tom, good question. He says, do levels from 2008 matter for S&P, Google, Amazon, NVIDIA, and other big components that weren't in the index? I would say yes. I would say all zones matter, right? I have the sign in my front yard. All zones matter. I think that even though they're so far away, so we can make the argument about NVIDIA, right? Let's go NVDA. You might look at this level down here, where it was this origin of this big pop-up back in 2020. And you go, oh, there's no way it's going to get to 50 bucks. It's 162 right now. My opinion is, it doesn't mean squat right now, right? The level of $54 on NVIDIA is, who cares? It's not there. But if all of a sudden this trend continues and we see NVIDIA keep breaking down, then I am concerned about that area, and I may manufacture a trade once it gets there. Now, regardless of whether it was in the S&P or not, right? Whether they were a member of an index, who cares? That doesn't really make it that much of a difference on it. It's the psychological impact of looking at this chart and seeing those zones and understanding that there was a reason it turned in the past. And even though, so here's one thing I got annoyed by, the trader I love to hate, the biggest. Yeah, whatever. I'm trying to mind my politically correctness out here, but the largest scumbag trader in the world, he will tell you that, oh, there's orders still in place there. It's like, you're a freaking clown. There's no way an order is still in the system over 2 years sitting there, you donkey. However, when you look at a price chart like this, right, there is no way that some institution has an order to buy at 50 bucks on NVIDIA. That's been in the system for two years. There's no way that is happening. Now, I can assure you that if price starts to fall, that these institutions are going to look at this level and say, okay, well, this might be a good buy point for us. So, while it may not be important now, it may be important when price gets to it. It's kind of like looking at the all-time highs on NVIDIA right now. Well, am I worried about shorting or going long at these levels? No. I'm using these historical supply levels, which were a long ways away from, as potential selling points. Like this last week, that big spike we had up. Awesome. Give him the donkey. I can't do it again, Big M. I give him the donkey of the day too much. I should put his picture up on the donkey is what I should do. You know what? Maybe that's what I should just change it for, instead of being a jackass or a donkey of the day, I'll just call it the Seiden of the day. And I'll just have a picture of Sam Seiden in the middle. You know what? That might be a good one. I think we might have to change this. All right. Anyway. So yeah, I think, Tom, even I don't care what the symbol is, whether it's futures, options, forex, it doesn't make a difference to me. If I see an old level that's on an unadjusted price chart and we're coming right into it, I'll start working on a potential trade setup for that and map it around that zone, even though it might be 20 years ago. You know, it's funny when you look back here, when we were doing, let's go back to the S&P 500 real quick and go back into, I got all these lines and boxes on my screen here. Let's get that off there. Yeah, see, look what it does here. You guys see this high right here? It says the high of the S&P back in 2000 was 1583. And then it says the high was 1394. But if I take and that's adjusted. If I take that off, notice it's a double top. Oh, Thomasina, you're great. Said, I hate for you to get sued. Well, if somebody, so you can't sue somebody for saying fact. And the fact of the matter is that the federal government, the Federal Trade Commission, subpoenaed Sam Seiden's trading records. That's a fact. And the fact that they posted it in the lawsuit that said Sam Seiden loses money as a trader and he doesn't trade very often. That's a fact. It's in the lawsuit. I'm just quoting what's stated in the FTC settlement. Plus, maybe talking about my experiences in working with the guy. I think he's a scumbag. That's my work experience. I don't have to like somebody. I can say it like it is. So, hard to sue somebody for please feel free to sue me, because I will just show the FTC lawsuit and then I will sue you for wasting my time and money. Anyway, so in this specific example, look how much the unadjusted chart changes. This chart, I would never be trading that supply zone because it never got there, but here it did. Right, so I think the supply and demand zones absolutely do make a big difference. And even though if you look at this chart here, this high was in 2000. Well, we got back up there in 2007. It took 7 years. You're like, oh, come on. That's 7 years ago. There's no use there. Well, to me, it really does make a big difference, and I think it's critical. Anyway, let me end the poll here. So we've got 15% of you using adjusted charts, or 14. That's weird. Apparently 1% of you decided not to vote. I don't know. That's a weird poll study. But 15% of you saying yes, use adjusted charts, and the others saying no. And again, I have my preference, but who cares? My preference should not matter to you one bit. I'm just conveying what the difference is on how these price charts look. Even just this most recent move is going to be changed significantly. Watch the way it shifts. Can you guys see, if we look from this peak right here on January 3rd, so let's go just this year, watch how much this chart shifts. Oops. There you go. I mean, those are pretty big jiggles, and that means that those levels are different. They're not working. Kind of psychological analysis versus technical analysis. A psychological level of 666, certainly. That is absolutely a major psychological piece of it. And the other part is, it actually got down there, right? So when you see this, one of the biggest sell-offs happen in the financial markets, and it stopped on a dime and ripped up the other way, your brain automatically wants to know, what was that number? It was 666. Great. Making a note. Because if we ever start to fall aggressively, my target's going to be 666. So that's the discussion I've got on adjusted versus unadjusted charts there for you skilled stocksmen. I'm happy for whichever chart you guys decide to choose. Just know that if you're using the adjusted charts, your chart data will change dramatically. Let's go Apple, and I'll put on a monthly here. This is a monthly chart, right? Oh, yes. Yes, we could have bought Apple back here at negative 50 cents or 20 cents. That's crazy. But watch what happens when you do this with an adjusted. So let's say this low, I don't know, pick a low. Here's a low back in 2013. Now let's go to these lows from 2008, right? The low was right on $2.79. Well, if I adjust that, well, that's not going to make too big of a difference, I don't think, because it's already near zero. I don't know, Jimmy. I'm not sure which chart's in CliK. That's a great question for somebody like Todd Davis in the GPS. It's a great question. But it will definitely tweak this chart, and these numbers start to change. And it may not seem that significant, but it actually is. So anyway, long-winded answer. Skilled Stocksman, I am in the camp of use the unadjusted charts. And if you use the adjusted, just know that those levels that you're looking at, price may not have actually hit those levels. Okay, now that I'm already got a scratch in my throat. Phone number ends in 666. That's a good one. You probably had to pay extra for that. Here's another question, which I think is very interesting. So I've brought this topic up in my CIL, my Crypto Investor Live sessions, which is good. And the point is this: with crypto, your crypto can be lent out to somebody else, and then you can earn yield on that. Think of it like a savings account. Now, of course, we've seen, because of the lack of regulatory environment, a tremendous amount of problems have arisen there, and we're seeing FTX go under, we're seeing Celsius, Voyager, BlockFi, etc., all go under because of bad lending practices. So what we needed really was regulation. Now, I always made the point, or I made the point in presentations in the past, that, if you have your shares of Microsoft sitting at E-Trade, well, they're not earning any money. They're going to make money for you if it goes up or down or whichever direction you're long or short, but you don't earn any passive interest just by keeping your Microsoft shares other than the dividends that they have declared that they're going to pay you. And I thought, well, crypto is unique in that sense because now I can start earning interest on the assets that I hold. And it really wasn't a big thing in the equity markets, although earlier this year, they changed a few rules, and now you can lend out your equities. Now, it's still kind of murky and not very clear to me, so I've reached out to a couple of brokers trying to get some clarity on that one. But here's the gist of it. Excuse me. It's called fully paid securities lending. And this is from Kurt. He says, I received an email from TastyWorks today giving me an option to earn passive income via fully paid securities lending. This sounds very similar to crypto staking, but with stocks and ETFs. Do you have thoughts or opinions? Fully paid equals cash settled, no margin, 100% eligible in 401k accounts. So, digging into this, it can only be in a cash account. So you can't use it in any margin accounts. Most of you have a margin account. So, deal, not going to be relevant. However, if you have a 401k plan, and in that 401k you're holding shares of QQQ, you may also be able to, in that retirement account, it's 401k or an IRA, lend out those shares of QQQ to somebody else. Now, for what purpose would that serve? I don't know. I can't really think of off the top of my head what might be an application for this. But they're saying it's now fully paid securities lending. And this is approved by the SEC. The interesting part about it, though, is when you lend it out, those securities are not SIPC insured, which I think to me would be a big red flag. Now, if you look at some of the firms that are offering it, you have TastyWorks. I think Ameritrade offers it. I think Fidelity does as well. There's some big firms that will allow you to lend out your equities. I have found nowhere that it discloses how much you would be getting paid. You would think that this may actually be fairly disclosed information. So I don't know if I actually trust this, Kurt. I'm not lending anything out. I don't own individual equities in my 401ks anyway. My 401k is all cash. My IRA accounts, I'm generally trading options in every account I can. So I don't have individual equities. Yeah, Fidelity does offer it, but I don't know exactly how they're paying the interest or the mechanics of it. So right now, a lot of these firms are talking about it, and I'm trying to get more information on it. But it's interesting how I think that this model has arisen because of cryptocurrencies and digital assets. Because I could take my Bitcoin, park it over at Celsius, and was earning 9% for a while. Great, it's awesome. Of course, now we see how that all crashed and lost a bunch of money there. So I don't trust it at this point. The good news is the entities that are offering this service, this fully paid securities lending, are major brokerage firms regulated by the SEC and U.S. regulatory agencies. So in that sense, I feel much more confident and safer in those marketplaces because I know I have that security of the regulators staying on top of it and not allowing shady stuff to go on. Yes, exactly, Tom. You're 100% right. You're more than 100% right. So if you do have equities in your portfolio, well, let me two things here. So let's say you do have a 401k and I've got some QQQ shares in there. Great. Well, why don't you sell covered calls against that and earn more premium? You'll earn way more than you will if you are lending it out to their program. I'm pretty sure you're not going to be getting paid a lot of money for lending out your securities. That's what I would be doing. And Tom, you're totally right. Here's the other side of it. When you fill out your paperwork, you're already, you may not know this, but you are already lending out your holdings at almost any brokerage firm. Now, years ago, I don't know what the text is in the actual statement. I believe it was an agency order with subscriber commission added was the terminology they used, something like that. And essentially, if you have 1,000 shares of Microsoft sitting in your Charles Schwab account or Fidelity or wherever, those are being lent out, right? Yes, your shares are quote unquote there if you need them, but people are borrowing those. How do you think somebody goes short? Anybody tell me, how does somebody go short? When you hit that short button and you want to short Microsoft, and you say, I'm going to short 100 shares of Microsoft right now. What's the mechanics of it? Remember, if you're shorting, you're borrowing. You're borrowing from somebody. So it's kind of strange that they're doing this now because they've already been borrowing your securities and lending them out. So, for example, when you hit that button, you say, I want to short 100 shares of Microsoft, and let's say you're using, I don't know, TD Ameritrade. TD Ameritrade will look at their entire holdings as a company of Microsoft and say, okay, we have 5.1 million shares of Microsoft. We'll lend out 1.9 million. There's some algorithm they have that allows, that shows they don't want to lend out too much of those Microsoft, because then what if there's a run in the bank? So they've got algorithms that say, here's how much we can lend out. But it may be my Microsoft shares that they're lending out to somebody else. It may be yours. So when you fill out your application, you are literally signing a document that says they can do this. They can lend out their shares. Now, your stuff is safe. It's secure. It's got SIPC protection. But it's being lent out. Now I think it's interesting that the brokerage firms are sitting there going, you know what? Maybe we need to draw in more clients, right? Like, how do we bring more people to us? And okay, we'll offer this fully paid securities lending. So when we lend out shares to be short, well, we'll give a little bit of commission to the people who lent us those shares. So I think it's kind of funny because I personally think this has been done for a long time. It's been there being used for decades, and now all of a sudden it's like, hey, we'll pay you for it. Well, okay, great. Well, how about, do I get a retroactive check for the last 20 years I've been trading? All right, my throat has had it. I'm beat. I told you guys I don't think I've ever done a 30-minute show. If I stopped right now, we would actually be a 30-minute show. All right, we'll keep going. Shorty's like playing the system, but hey, who doesn't? And look, Pepe, if people don't understand how to short, it really tells me that they don't understand trading. To not short these markets when the time presents itself is foolish. And typically that's what happens with most long-term investors. They're stuck in some long-term investments and they're writing things down, and they take significant losses in their big portfolio without either going short or protecting it using option strategies to hedge their accounts. Now, we talked about this at the beginning of the year, kind of how far that market was down. I got all kinds of different markings going on here. I'm just curious where we stand right now. So at one point we were down 27%. Ooh, we're still down 20%. 20% on the year. Now, I will be showing you probably when next week or week after, when we get to the tail end of the year, I will show you guys the spreadsheet, because I made a spreadsheet that we did as a group in January 2nd or 3rd. Remember, I asked you guys, where do you think the S&P will be by the end of the year? And I have them all tallied up and ready to go. I'm going to be pretty damn close on my end of year forecast. I think I said in mine, we'll be down 20% or more and finish the year down 15%. Oh, if only had money on the line. We're pretty damn close to that one. But, down 20%, I'm hoping that a lot of you have some alpha, right? You have some alpha. You are beating these markets. So if you look at this chart right here and go just from January 1st, put a vertical line there so you guys can see exactly where we were. We pretty much started the year off on a bad note and continued just selling off aggressively. And this is a monthly time frame here. So you see they say as goes January, so goes the rest of the year. Well, that one absolutely transpired and worked out this year. As far as accounts go, most people are going to be down this year. Most are going to have big losses in their 401ks, their IRAs, etc. And I'm hoping that we all have a positive year. I actually looked at my account balances. I am more than pleased. Not only am I not down at all, I'm actually got pretty significant gains this year because I positioned myself appropriately and capitalized on some nice moves. So it's been a phenomenal. Anytime you can beat the market, you're doing well. So when I say beat the market, I mean, if you had an 18%, let's say we ended right now down 20%, and you had an 18% loss, you actually beat the market because the market's down 20. But if you have positive gains on the year, that's great. Lori, what I mean by alpha is beating the market. So, seeking alpha, there's a website out there called Seeking Alpha. What that essentially means is if the market is your bench line, if you beat that, you have alpha. Yep. Yeah, John, great year in the IRA selling puts. Yeah, it's funny because one of my better performing accounts was my 1% account. That was a pretty great year just for selling options in that account, especially as these ones are dropping. But I've had a couple really good counter trend trades here that have done very, very well for me this year. So Seeking Alpha is basically saying I'm just trying to get gains and beat the market. And I think I've told you this many times on this program. For me personally, I don't have a month or a percentage that I'm shooting for. I don't strive to make, 50, 100%, whatever. I don't do any percentages anymore. I'm just trying to have alpha. That's the goal. Beat the market. So if whatever the market does, I want to do better than that. And, sometimes you don't. And it's unfortunate. You're like, why didn't I just buy the market? But on the whole, beating the average market rate of return will do very well for your portfolio, especially a year like this where you have markets are down 20% and you're actually up on the year overall. That's your major alpha there. All right, let me go through and just show you the economic counter and earnings counter for tomorrow before my throat completely gives out on me and I'm done. And there it is. So earnings-wise, we don't have a lot of really important earnings this week, although there are a couple big names happening tomorrow. This is FedEx, Nike, General Mills, and BlackBerry. Now you'll see on the hard right edge over there, AMC is after market close and BMO is before market open. So obviously you have some coming out before the market's open, some after it closes. And I'm interested with General Mills. The reason I'm interested in General Mills is we've seen these commodity prices have some incredible swings over the past few months. Here is the daily, this is the monthly. So here's your wheat, and you've seen wheat drop significantly over the past 3 months. And here's corn as well, has been dropping. And that may, maybe not this earnings announcement, but maybe the next couple start to impact their bottom line, right? Because as the prices of wheat and corn start to drop, a company like General Mills may actually start to produce better profits depending on what they've procured their wheat and corn at, right? It's all about the futures markets trading there. And then we look at the economic calendar for tomorrow. Nothing major for the U.S. There are a couple announcements that relate to the housing market. You can see building permits and housing starts. Those are going to be at 5:30 Pacific time, so 1 hour before the market's open. And, there still is this looming question of, is the housing market dead? Is real estate dead? Is that 10-year starting to crush this market more than expected? And that's still a topic of debate. The good news for the neighbors to the north there is your retail sales numbers are expected to be much better. Ours came out much worse. So at least somebody's getting some good retail sales numbers. And other than that, not a lot of major, significant, important economic announcements happening for tomorrow. All right, well, I'm out of breath. And I'm going to have Bill Addis on the program tomorrow, so we'll take a step back, look at Jerome Powell's comments, what he said at his FOMC meeting. What about this horrible 10-year bond auction and what it might mean for yields and interest rates going forward? As you guys know, Bill Addis is one of my personal favorites. So if you have questions for Bill or myself, you can email me at TraderMerlin@gmail.com, which is on your screen, or just put it down below any YouTube video. I take those questions, I put them into the slides as I did today for Skilled Stocksman, and I have some other ones that we'll be probably going over this week. So that will do it. KF Bitcoin is dropping right now. As you're watching the show, do you know what the reason in that one is? No, my guess is it probably has something to do with old Sam Bankman-Fried. He's, who knows? I don't know. Let's look at, bring it up over here for you. Let's look at the daily here. Oh yeah, that's a pretty significant drop there. It's only $300, big deal. No, I don't know. I'll probably go sit on the couch and look it up for a little while, but would not surprise me to see some big announcement that happened with FTX, Sam Bankman-Fried, lawsuits, etc. But that's it. All right, everybody. Before I hack in your ear anymore, sorry for the coughing. Okay. Hopefully I'll be better in the next couple of days, but I had to do a show. I hope you enjoyed it. Tomorrow will be Bill Addis. So again, questions, TraderMerlin@gmail.com or down below any YouTube video. I will see you tomorrow. Take care, everybody.